Welcome to Blue Chip Now, the podcast that gives you insider access to content that we tailor specifically for our clients. Whether you're climbing the corporate ladder or just seeking smart, efficient intel, we've got the answers to your most pressing financial questions. Join us as we break down the markets, debunk the headlines, and keep you ahead of the curve. Let's dive in. Hello and welcome back to another episode of Blue Chip Now. You have Daniel Dusina, Matt Mondoux, and Dan Seder. Last week, we saw equity and bond markets continue to grind higher after that blip on the radar that happened early August. And so in light of that, and the fact that we haven't really talked anything market analysis related over the past few weeks, I think today's a good day to dive into what's going on underneath the hood of the market. We'll talk a little bit about returns of different asset classes, what's driving them, and what to expect going forward. So that's things like small cap and large cap. We'll talk about some of the interest rate paradigm, what's happened there and what that could mean going forward. And then we'll talk a little bit about the election, any updates there, I would say relevant updates as they pertain to financial markets. So I guess just to start, we started the month of August with this, what felt like catastrophic drop in the equity market, and that has ultimately proved to be fairly short-lived. What do you both kind of make of that?
So, Daniel, take a step back. What was the drop predicated on? Was it more the labor reports? Was it more the yen carry trade? Can you describe basically what happened for the listeners just as a backdrop?
Yeah. Well, what I will say just as a caveat to that is whenever you have massive market moves like that, it technically is impossible to say exactly what drove it, but if you're asking me what I think drove that, I think the yen carry trade, which I'll explain in a minute, was part of it. But realistically, I think the bigger driving underlying force of that just was a very soft piece of economic data, specifically related to the labor market. So when you have an environment of slowing inflation and there are overall fears of slower consumer spending and slower economic growth, to get a non-farm payrolls report or a jobs report, which is released the first Friday of every month in the United States, that was way, way softer than expected and showed things like not just lower than expected level of jobs added, but continued slowness in wage growth and productivity. That's going to freak some people out because realistically, the markets continued to be focused on the Fed and the Fed is focused on labor and inflation, and thus people are focused on labor. So I think that was probably the biggest driver, and people do tend to be knee-jerky and stuff like that when you've got hot button reports like that come out. Now, what could have exacerbated it certainly was this whole yen carry trade, which we're probably a few weeks late in talking about and explaining, but nonetheless, I think it's conceptually a good thing to understand. And I guess I'm going to try to do this on the fly here in terms of like illustrating an easy example of this, but let's just say there's an opportunity, call it an arbitrage opportunity, one where there's riskless profit. That's the definition of arbitrage. If you have an opportunity to borrow money at 2%, let's just say German bunds or you can borrow in the euro at 2%, and then you can go and invest it in another country like the United States at 4%. That's a pretty good winning proposition, right? So that's basically what people were doing with the Japanese yen for a long period of time. In Japan, for a long period of time, there have been very low, if not negative interest rates. So banks are essentially paying individuals are paying banks to park money. And so money is very cheap there. They can take those dollars and go and invest them abroad in places like the United States, where the 10-year treasury is kicking off 4 to 5% annually. And that's a great trade. Well, when the Bank of Japan says that they're going to start increasing interest rates, people are going to start unwinding those trades. And that's part of what you saw exacerbating the move downward in the domestic equity market.
Got it. Makes sense.
Yeah. So it sounds complex when you don't know what a carry trade is, and you really don't need to understand what a carry trade is. You just need to know that people were borrowing money really cheaply and investing it elsewhere because rates were higher.
And also, even more simply, sentiment was extraordinarily high in the U.S. People were very bullish on stocks.
And so what happens when people get really bullish, Matt, compared to when people get really bearish?
And I think everybody can understand the concept. There's more sellers than buyers, right? At that moment in time, there's more sellers than buyers. And because we run out of people who are going to buy, have already bought. People are looking for an excuse to take profits. Ultimately, it can be any number of things. It could be a jobs report. It can be a yen carry trade. But these things are kind of percolating beneath the scenes, and pressure has to get released out of the system.
Yeah, it's like a spring that keeps getting coiled, and then the data, maybe it's the economic data or the yen carry trade, which is the trigger, but that spring is coiled and it's ready to release.
And that's why it happens fast. You take an elevator down, but we've taken a pretty quick escalator backed up because things aren't as bad as we might have imagined them to be at the beginning of August.
So sentiment was really bullish, and sentiment we've talked about before is more valuable when it's at extremes.
Correct.
So if there's an overwhelmingly bullish sentiment out in the marketplace, which we can see from investor surveys, then it would be a reason for investors to be cautious. If investors are overwhelmingly bearish, if the investor community is saying don't buy, and they're all sellers, well, that's a lot of times, depending on your time frame, but a lot of times a good time to enter the markets and be bullish.
Yeah, I mean, it's proven to be a great timing tool. Now these opportunities occur very infrequently, so you can't sit here and wait around for this, once every 10 years opportunity. But that March 9th of 2009, sentiment was extraordinarily bearish. It was the worst it would get.
Right.
And that was the time.
March 23rd of 2020. It's the same concept. And I find that fascinating just psychologically as an investor because so often we're talking about valuation and, emerging markets. I think of emerging markets where the companies in these emerging markets are getting cheaper and cheaper and cheaper. And it seems like for a decade, people have said, well, valuations are really attractive in emerging markets, so you should buy emerging markets. Well, valuation isn't necessarily the best timing tool because the valuation just kept getting cheaper and cheaper and cheaper for many, many years. Sentiment, I think, is different. When sentiment hits extremes, that's almost like, okay, there's something brewing. This can't maintain this force of either bullishness or bearishness forever. Something's got to break.
Yeah, everyone's already sold.
Yeah.
So who else is left to sell?
Yeah. So I think it's important. Sentiment is an important factor in the investment process. It's not the only tool, but it's one of the tools in the tool shed.
Yeah, it can just help you as an investor get a little bit more confidence in terms of timing. Not that you really want to try to time the market, but I think when you have an interesting factor like that, I mean, that's something I pay attention to.
Yeah, because we spend a lot of time, right? The markets go down, the markets go up. The media has to craft a narrative. They can't just say, hey, on Bloomberg today, we're just going to talk about how the market is. They have to come up with a narrative because they're ultimately there to sell advertisements, keep people watching the channel. So, nobody's just going to say, yes, sentiment was too high. But in a lot of cases, I think these things can clue us into what maybe takes a news story and makes it a little bit worse amplifies it from a market perspective.
Yeah. So Daniel, we talked about there were some reasons the market sold off. The market has since bounced back. Where are we at today?
Yeah, well, depending on what you're viewing as the market in the U.S., you could say that we've actually recovered all of the lost ground back to all-time highs. So the Dow back to all-time highs, not necessarily right this second, but you get the gist. Same with the S&P 500 equal weighted index, which we would generally view as a better representation of the broader market. The S&P 500 cap weighted almost got back to its previous high pre-August 1st. So,
but that cap weighted index is predicated on the performance of 7 really, really large companies. Yeah. So the equal weight, I think, is a better representation because it equally represents all 500-ish companies in the index.
Yeah, that's well said. And so when you see a recovery like that, well, I guess the first thing that comes to mind to me in terms of a question is well, why did that happen? What drove that? So, I mentioned that a lot of the time you can get knee-jerk type reactions. I think that was part of it. But the other part of it certainly is related to the Federal Reserve. And stepping in and essentially more or less committing to reducing the level of the baseline interest rate here in the United States, which, as I said at the very beginning, is and has been the focal point of investors and the market in general. So, we came into this year with broad expectations for some serious rate cuts. I think coming into this year, we had expectations for 6 rate cuts. Almost immediately, that started to get walked back, at least by investor perception and expectation, all the way down to the point where at the end of April, you only had 1 rate cut that was expected to be enacted throughout the course of 2024. And that was because you had just a continuing level of economic strength. So when you have an economy that's running hot and essentially growing as it should be, you don't necessarily need to stimulate that economy further, which is what cutting interest rates aims to do. Now, if you fast forward from April to today, we've talked about how we've seen some deteriorating economic data. That jobs report was certainly an example of that. And you've had the Fed that's come out and without saying it, essentially committing to stimulating the economy in an attempt to make sure we don't go into this free fall economic type downturn, and just kind of stimulate things and make sure this is just a slowdown, not an actual kind of catastrophe. And the market has paid attention to that for sure. And I guess I just want to talk a little bit about, or just open the dialogue on different asset classes.
Real quick, before you jump into the asset classes, so with regards to Powell's comments, or his soft commitment on cutting rates, was he open at the beginning of the year? Do you remember what some of his rhetoric was at the beginning of the year? Even though the futures market was pricing in 6 rate cuts on January 1st, what was Jerome Powell saying back then? And is it different then than it is today? Any comments there?
Yeah.
I don't quite recall what
if you want to find, if you watch Powell's press conferences, or to be honest, anyone in his roles, press conferences or Q&A sessions, they're about as non-committal as you can get. And that's by design. They have really ratcheted down on making sure that people like Jerome Powell are going to be less market moving. Because you can imagine if he came out in January and said, we're not going to cut rates until October, like that would have cratered the market, right? Like, right or wrong, it doesn't matter. Like, it would have caused some serious issues.
Yeah, because it was so vastly different than what the bond market had priced in.
Exactly. And so what you can perceive, and it's actually hilarious when I take a step back and think that most people don't view this as a normal thing, that when Jerome Powell goes and gives his prepared remarks, which have to be prepared because, in an attempt to not stoke volatility, he literally has to have scripted remarks.
Well, I think there's 12 words that are different.
Yeah, and so
different releases.
That's what I'm getting at.
Yeah.
You can pull up the PDF of the previous press release with the commentary, and then you pull up the current months, and usually someone on the sell side will highlight the 12 or 13 or 15 words that are different. And it's not like it's a major difference. It's something to the tune of, we will continue to watch the data closely, and we have watched the data closely and have observed. It's just that minutia of the difference.
He said substantial instead of broadening.
Right.
Just little tweaks.
So people watch that type of stuff. But he had no committal remarks at the beginning of the year. This was just investors and market participants extrapolating what they think was going to happen based on the underlying fundamentals of the economy.
Got it. Okay.
Now, today, we do have a little bit more concrete verbiage coming from the Federal Reserve, which ultimately, that to me gives some of what's happened in the market a little bit more legs. Different types of assets perform differently in different interest rate regimes. So you can take probably the easiest example would be your bond proxy income-oriented equity sectors, as we've talked about before on this podcast, that generally should perform well in a falling interest rate environment and should perform.
Maybe you could remind us what sectors those are.
Yeah. So sectors like utilities, real estate, to a lesser degree, consumer staples, and then the telecom portion of communication services. those are the sectors that you generally will see do well in a falling rate environment and not so well in a rising rate environment, because they are, like I said, bond proxies if investors are using them for income. If interest rates are rising and you can get essentially income from the bond market, that is going to impede on the attractiveness of those bond proxy sectors. The exact opposite is true when you have falling rates. So falling rates, you might have investors look towards those sectors in an effort to kind of supplement some of the income being produced by the portfolio.
So if I can't get a high enough interest rate in my money market as rates come down, instead maybe I invest in a utility stock because the utility stock is perceived to be relatively safe and a higher yielding type equity that can get me the income that I might need.
And it also has a lot to do with how their balance sheets are constructed. So the reason these stocks tend to be more interest rate sensitive is they have a lot of debt on the balance sheet. They're financing large capital projects. Lower interest rates are better for their earnings, all else being equal.
Yeah. And so that's a very clear-cut example to me, but I think there are a lot of other less kind of clear-cut examples where the data can tell you one thing, but it's not super concrete because not every period where we've had rising or falling interest rates told the same story. And I guess one area in particular that has seen a massive bounce back since the beginning of August was small caps. So small caps have been second fiddle to large caps for the better part of the last decade. We have seen small caps gain some traction this year. And then they essentially have regained footing to a massive degree after that initial blip in August. And so I guess the question is, do you guys perceive a declining interest rate environment to be more beneficial to small companies that are publicly traded relative to large caps?
So I'll go first. I mean, the premise there is that, generally speaking, all else being equal, a larger company will be more attractive to lend to. They'll get a preferred rate on a bond issue or, some type of lending to finance capital expenditures or growth than a small cap company will be. So higher interest rates, all else being equal, hurt small cap companies more than they hurt large cap. So, under that premise, you could say that small caps should do well relative to large. However, the past 10 years, that's not been the trend. So when we've had interest rates at zero, we have not witnessed this explosion in small caps outperforming large caps. It's been the opposite. So I'm really hesitant to say that. Now, could you see a counter trend rally? So meaning small caps outperform for a short period of time because of a small valuation discount? Perhaps. But I think there's a lot more fundamental issues going on in the small cap market. That's, private equity for one, venture capital, and, basically large cap companies, mega cap companies gobbling up small cap businesses before they ever really get their foot, hold. I mean, this is the equivalent of, imagine Amazon getting acquired back in 2000 by some other business.
All good points. Daniel, when did the interest rate hikes start? Was that March of
2022?
22?
Yeah.
March of 22. So I'm looking at a chart of small caps, and you can go back to, call it February of 21, and they're relatively flat. So, they saw this massive run up post COVID just because, like every other stock, they had some drawdown. But they ran up post COVID, and then since February of 21, they've been flat. But they suffered when rates started ticking up, at least in this last cycle. And I thought you brought up some great points. It comes down to lending, borrowing. It's more advantageous for a larger company relative to a riskier, smaller company. But I also think of just the stimulation from in the markets from a reduction in rates. So a reduction in rates is generally a shot in the arm for the stock market. And smaller companies are riskier, and they're what's called higher beta, meaning their moves are amplified both on the upside and the downside. And so if there's any impetus for stocks or any type of shot in the arm for stocks, in general, you would assume that small caps, because they're amplified in nature, are going to get a bigger jump out of that stimulus than something like large caps. Now, we haven't seen that consistently over the last 10 years. We've seen this over the last market cycle, but no one knows for sure. But there's certainly an argument for small caps. I think a legitimate argument for small caps to continue to do well in a declining interest rate environment.
So I think the only other thing that I was thinking about is, if you're going to talk about how are small caps related to interest rates, I think you have to think about, okay, like why is the Federal Reserve changing the level of interest rates? Because I think the general perception around small caps is that they tend to do better when the economy is booming and growing really quickly, right? You said these are small businesses that are going to be reliant on economic prosperity. And so I saw some interesting data from, let's see who published this. This was from GlobalX that essentially said, yes, you can say that a declining interest rate regime is good for small caps, but it actually is investing in small caps at the very end of that cutting cycle that is the best time to invest in small caps. And I guess when I think about that rationally, it kind of makes sense, because if you are investing in a business right at the beginning of a rate cutting cycle, rates are being cut because the economy is not doing well, right? Mm-hmm. And so by nature of that, I would assume that small businesses are kind of struggling. If you proceed through that cycle, whether it's 6 months, 12 months, 18 months, it doesn't really matter. But I think the whole notion that the Federal Reserve is no longer cutting interest rates would, to some degree, point to the fact that the economy has regained some traction and is healthy and is growing, which would, to me, line up with conceptually when I would expect small caps to do well. So I just thought that was interesting to see some data around that. And that doesn't change the fact that what Matt said about interest rates and borrowing costs, that might end up being a bigger factor in this cycle for small caps, just like it was in 2022.
Right.
Who's to say? But these are all the types of things that I think investors should be considering when you're looking at different types of assets, whether they're stocks, bonds, big, small, et cetera.
Yeah, totally agree.
So, I mean, obviously we've seen some gyrations in the market, and it's funny that even approaching a pretty contentious U.S. presidential election, that polarizing election has not been the factor that's stoked volatility. So do you guys have any updates, or I guess anything you want to touch on related to the election and, return expectations and all that?
So I'll jump. We could talk about seasonality. Maybe I'll touch on that next. But the number one question I'm getting from clients right now is, how is the election going to affect the stock market? And I think it's a misconception, because we've become so polarized as a society, and our beliefs, our fundamental, or our beliefs as human beings often align with one party or the other. The election can be really emotional. Okay, so if your candidate wins, you can be really excited for the outlook of the country. If your candidate loses, you can feel like everything's going to, crash and burn, and this is going to be Armageddon. When it comes to the collective wisdom of market participants or the stock market is relatively indifferent between Republican or Democrat in the office. Now, yes, it can matter from a sector level perspective, or it can matter over time on the direction of the country and things like foreign policy and just, a number of other factors. But when it comes to stocks, the stock market is generally indifferent who's in the Oval Office. What the stock market does, in fact, want is gridlock in Congress. Okay, so it's less about the president and more about gridlock in Congress, so that both parties, in a sense, are forced to reach across the aisle and compromise in some way, shape, or form. So it's a fantastic system that we've designed here for all of us to get together and meet in the middle. I think the biggest risk to an election like this is that one party walks away with a complete, run at Congress, total slide, and they have carte blanche with policy. So that's really the big risk. And once the stock market recognizes that that's not going to happen in November, and once the election is done, and there is somewhat of a gridlock in Congress, this cloud of uncertainty lifts, And from a seasonal perspective, in the fourth year of the election cycle, you see the markets rally from November through about April of the following year to complete what would be the best 6 months of the year, leading up into the sell in May and go away that would come in May of 2025. So when I think about stocks, I'm bullish in general because I think the Fed has firepower, right? They have the ability to cut rates. When I think about the election, I think it's highly likely that there's some, regardless of who wins the Oval Office, there's likely going to be gridlock in Congress. And if that happens, I think that's another boost to stocks, and it gives us a runway of, who knows, it could be 5-6 months of stocks to continue to rally going into 2025. TBD, right? We in February of 2020, no one was talking about the lasting impacts that COVID has. There's always curveballs that the stock market can throw, but I'm looking historically at the seasonal trends from what occurs in an election year, and that's what we see.
Right.
And either way, I mean, no matter which side of the aisle you're on, and we talked about this kind of before the podcast, it's paid to be an optimist. So Republican, Democrat, it's paid to be an optimist when it comes to America, earnings and profitability in the markets so far. So I would strongly believe that trend will continue no matter who's in the office. That's where I kind of stand.
And does that relate back to CEOs and earnings and the ability to run an audible if, maybe the policy du jour doesn't go your way?
Yeah, I mean, I don't think the narrative will be the guy that I wanted to get elected or gal that I wanted to get elected didn't get elected. Therefore, I just have to wind down the company. Let's sell assets. Let's close the door. We're going to lay people off. And the best thing going forward for this business is just to wind down. I don't think
to throw in the towel.
That will not be the narrative. I can assure you that the job of the CEOs, the job of the leadership of the businesses is to produce profits for their shareholders. And that's what they're going to continue to do. And they're paid well to operate in whichever environment exists.
And they also have a heavy stake in that company because most of those executives are paid in some way, shape, or form in company stock.
Right. And so that's where I land. I think, you have to look past it a little bit. The election's an event. It is a significant event. It's an emotional event. Again, we will tie market narratives to politics. But at the end of the day, it's seemingly based on the data, it does not matter that much.
Yeah.
We're talking a few percent no matter who's in office.
And it can matter according to your personal beliefs. It can have a tremendous impact on how you view the outlook of the country moving forward. So that we're not trying to take away from people's personal and political beliefs. When it comes to stocks, the stock market is less emotional. In fact, it has zero emotions when it comes to the election.
Beautiful thing.
Yeah.
Anything else, guys?
Not for mine. I think we covered it all.
Yeah.
Okay.
Yeah.
Great. Well, as always, thank you so much for joining us. If you haven't yet, be sure to check out our YouTube channel. We have plenty of exciting content over there, and you can see our beautiful faces talking to you today. That's a wrap on another episode of Blue Chip Now. We'll speak to you next time.